Sandip Sabharwal joins us. Sandeep, the excitement of tax cut, can that be taken away with what is happening to the tariff hike?
Obviously, the volatility that the tariff hike moves will create will dominate what has been done in the budget in the short run. Uh, However, I think the budget overall was positive for consumption, and that will play out as the year plays out. So, the disruption due to tariffs is because of two things. One, tariffs have been imposed, they were being talked of, people were thinking they might get postponed, but they were not. And secondly, there are threats of more tariffs. So I think this entire thing eventually will lead to slower global growth. So India is relatively insulated, but if there is an impact on global capital flows, then obviously India also gets impacted. I would think that as an economy, India is least impacted given its lower linkages in terms of the domestic economy versus an export economy. However, I think any global moves will obviously have an impact, and that will be seen today.
Sandeep, what is it that one should do in terms of a portfolio allocation? Because the most obvious emotional trade on Saturday was buy consumption, sell capex.
So, buy consumption is a good theme. Sell capex now, that's an somewhat overreaction because finally, what has happened to capex this year is already in the stock prices. Next year projections indicate a reasonably good hike in overall capex. So I think there is an overreaction there. So we need to focus. So consumption obviously will be an outlier. They are under-owned stocks. So I think durables, non-durables, which include brown good, white good companies, autos, and FMCG companies, I think these are likely to outperform for some time because of the fact that not only there's a positive fillip for them, but they also under-owned. Now, capex infra theme companies, I think they have also become reasonably priced post correction, which we have seen over the last few weeks. Now, it's also important to see what the monetary policy action is because if liquidity is further improved and rates come down, typically these are rate sensitive companies, so they'll get a support because of that.
One has a portfolio, and the portfolio after the market fall, I don't think it, I mean, really everybody's sitting on a lot of cash. So if consumer looks like the go-to space in the near term for obvious reasons, and if capex could take a back seat, and if somebody has to choose, it's a choice between, let's say, HUL and L&T, or it's a choice between ITC and let's say BL. I'm just making this for our viewers in terms of setting the tone here. Is one better off locking out of 15% of their capex stocks, which is the build India stocks, and move that portfolio right away into consume India stocks, which is FMCG, consumer, autos, hotel, discretionary spends, low ticket, brown good, white good?
It makes sense because next 2 years this theme should outperform. So, but what do you move? Then you have to decide whether you move out of some of the capex themes or you move out of some of the export-oriented themes. Because IT industry outlook will become more hazy if the overall US economy and global economy outlook becomes hazy. So I think it's a choice which people have to make, and it also depends on how is your current allocation. If you are very heavily underweight consumption because consumption was doing badly for the last 2 years, then obviously your move has to be much greater. If you already own a few of them, so I think it will depend portfolio to portfolio, but overall, I think consumption as a basket has to be overweight now.
Overweight consumption, that's the takeaway from the budget. But let me take it across to Aditya Arora as well, getting some stock strategies as we get closer to the pre-open rates. Aditya?
Very good morning to you and very good morning to everyone. Look, I think on Saturday, market closed little lower, but the final, problem for the market is global markets, which are down Pretty much. So I think, and FI is also pretty short. So I think short strategy could be the best strategy right now. So I have a short on NCC, which is currently trading at 231.60. So it's a sell at that price. Stop loss 242, target 221 to 210. This is the first one, and second one is REC. That is also sell at 427.85. Stop loss is 441. Target is 413 to 405.
The take coming in on how some stock strategies could actually play out. But Sandeep, just going a little deeper into what within consumption. FMCG is price inelastic, so maybe the reaction on Saturday was a little exuberant. Would you say stick with the premiumization theme?
I think impact will be felt across the board because of the fact that demand has been subdued across the board. So I would think durable companies, which include like brown good companies, white good companies, autos, as well as FMCG companies, I think all tend to benefit because of the fact that the tax breaks are very significant, and it has been proven that tax breaks given to people who are on the lower to mid income bracket have a much greater impact and multiplier on consumption than those given to the higher income brackets, because they as it is are not so impacted, so their consumption as it is going on. So uh, I think the impact should be across the board, and the biggest factor in all of this is these sectors are heavily underowned. If you see large funds, if you see large even blue chip funds, etc., their ownership of consumer stocks or even the mid-tier investment themes is very low. So I think that will get corrected over the next few months.
Let's get some names within consumption because that's where valuation comfort also is, at least when it comes to the FMCG basket.
Sorry, I missed the question.
No, I just wanted some names where you think there is valuation comfort also, and within the consumption theme can be bought right now.
The consumption theme valuation never go down so much, so I think they always remain high. But I think segments which could benefit more would be, let's say, the QSR space, something like maybe Devyani International, Westlife, Jubilant Foodworks, because they have been under a lot of stress, and as sentiments improve, we could suddenly see people wanting to go out and consume more. Then on the brown and white goods side, there are a lot of companies. So uh, not not necessarily in order. So Crompton Consumer is there. We have companies like V-Guard Industries, Voltas, Polycab, and a few others on the white and brown goods side. So all of them could benefit. Then autos, obviously, the numbers are also decent, and there are also uh, companies like Eicher, Bajaj Auto, Maruti, Mahindra and Mahindra. So all of them could benefit. And on the FMCG side, across the board, I think, because one good thing about most of the consumer companies is they don't tend to raise equity. So equity remains the same. So capital raising is low. So to that extent, any positive move tends to be outside. So Britannia, Dabur, HUL, and like there's so many well ITC, so all of them I think tend to benefit. So everyone has to make a choice on where what they want to allocate to.
Well, talking about autos, there's the monthly sales data as well, which the market is going to react to this morning. Stehi flagged off some of the names. For Eicher Motors, it's been strong. The monthly sales, they're 4% higher than estimates across the board. Hero MotoCorp, the total sales have come in line. The export sale have seen a bumper uptick of nearly 141%. Sandeep, within autos, like you were mentioning, any particular theme that you would pick up? Would you say that it's going to be two-wheelers versus passenger vehicles? Any segment you think which will do particularly well?
I think the companies which are doing well, so companies which are standing out in terms of what they've been able to deliver, export plus domestic, and on valuation basis have been companies like Maruti, M&M, Eicher Motors, Bajaj Auto. So I think they have been doing well. So I think those four could be the preferred ones.
Okay, some of those themes are going to work out well. Kunal, on the charts though, what's looking like a good buy right now within the auto pack?
So I believe we were discussing this Eicher Motors as well as M&M. I think both of these stocks they start to look very attractive. So there are two divergent trends within the auto pack. The ones which are very strong and the ones which have not fallen very sharply in the last 2-3 months of the market correction. And in that sense, M&M and Eicher Motors they rank to me amongst the top performing relatively strong names from the auto pack. But then, eventually there would come a point where the underperformers are the ones which have been beaten down 30-40% from their September highs. I think these stocks would also start to look very attractive. In that pocket, I believe Bajaj Auto is something which starts to look very attractive, especially closer to that 8,500, 8,800 range, where the stock has formed a major bottom for itself. I believe that the risk reward for the stock at current levels looks to be far more attractive. So these are the top three names which I would concentrate on from the entire auto pack.
Sandeep, you did make the point that perhaps, the selling in capex was a little exaggerated. I mean, stocks like NCC fell about 8%, IRFC, JSW Energy, ABB. I think Saturday was more of an emotional trade, perhaps. But how is it that you would rejig your portfolio when it comes to the capex theme right now?
I think there are some companies where it's a so where the demand trends are pretty strong. So I think which include companies which would be supplying power ancillaries, transmission tower, etc. companies. So I think those are still doing well. On the other hand, we've seen that there are some themes related to railways, related to uh, some investment cycles which are government funded, where we've seen some slackening. So I think we need to see how that overall thing plays out. But uh, I would say that the valuations post the kind of sell off we've seen across the board on the capex side also, because if you see, many stocks are down 30-40% already. I think a lot of it is already built in. Now it will depend on the pace of recovery.
Aditya, before we let you go, just wanted a chart check on three of the names which saw a big spurt on Saturday: DMart, Trend, and then, of course, Interglobe Aviation.
Sure. I think among all these, DMart looks very good. A name which has been forgotten by many on the street, and technically also this looks pretty good. So definitely thumbs up on DMart. Currently trading at 3984.65. It's a accumulate candidate as market is volatile, so it could be accumulated in phases. In the range of 3,700 to 4,000. Stop loss should be placed at 3,500 and targets on upside are 4,400 to 4,600. And when we talk about Indigo, then I expect some volatility on that front. So among these three candidates, I think DMART looks the best.
DMart looking best, has consolidated for a while, a massive uptick of 10% on Saturday alone. Let's see whether that trade continues today or not. But Aditya, we'll let you go on that note. Thanks as always for taking time. Sandeep, hotels, that also stands to be a beneficiary of consumption and more money in the hands of consumers. Within the hotel pack, would you stick by with IHCL or would you diversify your portfolio?
See, we have a larger stake which we own in Indian hotels, which continues to do well, and there's no reason to sell because the company has indicated continued good growth, and if the tax incentives also help some more people spend, they could do better. Uh, but these tax incentives could actually benefit the cheaper hotels more, I would say. So there are a few other hotel stocks listed. So I think uh, as a percentage impact, there could be a greater impact on those than IHCL purely on these measures.
Interesting. In fact, we spoke with a whole host of experts post the budget speech as well as to how is it that the Indian markets are going to play out from here. Which sectors should one be betting on after the big consumption boost? Hear out some expert opinion.
Manufacturing clearly, we can see the multiples on companies like Dixon and other manufacturing outsourcing services, and I think these can expand massively. So I think that's one area that is likely to do well, and I think we need to provide enough boost to that. All real estate is a very, very significant sector for us. It's still a very small, the organized real estate sector in India is still very small. If this credit and consumption, are being pushed the way they are, I think there's a long way to go.
There is a need to segregate within the capex cycle also. So there is going to be a change of hands in the capex cycle from central government towards private sector, and there is going to be a broad basing of the real estate from the premium end to the more mass and lower end of the economy. I would say definitely some amount of exposure if the portfolio has not been showing some amount of exposure to consumption, then this is the time to be adding.
There is a case for a greater allocation to discretionary consumption, right? So whether it is autos, whether it is retailing, I think there will be some pickup that we will see going forward. Another area which I think will be very interesting from a consumer perspective would be real estate and tourism. Right, these are two sectors which should benefit.
I would prefer a digital company rather than ऐसा consumption में होगा, लेकिन digital consumption company is better off than non-digital consumption company. Banks मेरे हिसाब से they should do well. मेरे को लगता है banks overall जो है ना अच्छा ही करेगा, क्योंकि MSME और अगर जो सब लोन गारंटी हुआ था वो भी उन्होंने बढ़ाया है. 25-26 मेरे को लगता है बैंक्स के लिए गोल्डन पीरियड होगा, when their credit cost will be normal and hopefully there will be leeway in terms of their credit expansion.
Okay, some themes to play with when it comes to the budget equivalent. Just a couple of other names. Look out for HDFC Life. Some of these insurance plays got pretty hard cracked on Saturday. The GST education authority has passed the order confirming a 942 crore rupee demand. So HDFC Life is going to weigh down perhaps. And for ICICI Lombard as well, there is a penalty of 550 crore rupees that has been slapped by the GST authority. There was also MOIL. The January sales have come in higher by 17%. They've raised the prices of different grades of manganese ores. So look out for what that stock as well does. And then, of course, Coal India, wherein the January offtake has come in higher by 2.25%, and coal production as well is down about 0.8%. But what are brokerages saying about budget? What's the consensus view? What are the sectors and stocks that they're all betting on? Sharad is here with more details on the same.
First one is CLSA coming on India's property, and they have stated clearly that the budget impact is marginally positive for the real estate sector, especially where the lower taxes are expected to come for second homes in the same city, and the benefits would be roughly 2 lakh rupees per annum. Jeffries also came out on OMC's report, and they have stated that a slight negative reaction would be there in the stocks. OMCs will bear roughly 69% of FY25's under recoveries for the regulated product for the first time in 9 years, and the government has capped the market profitability. So, of course, BPCL, IOCL and HPCL, the ratings have been maintained, but the target price have been slashed, and they have slashed by 10%. For BPCL, the target price is at 330, IOCL it's 150, and for HPCL, its target price coming at 270. If let's look at the Bernstein's report on insurance, and over here they have stated that the street's initial interpretation on ULIPs are now taxable is inaccurate, and they've stated there would be a negative impact coming in for digital link sales for the life insurance as well. JP Morgan on infra, that space, of course, we know that the capex numbers which were expected, those were lesser than what the street was estimating, and there has been an underwhelming growth in the infra related capex for FY26, and also they've stated that defense capex, that's expected to however grow up in FY26 after a muted FY25. Now they've stated railway capex, that's expected to remain flat in FY26, and a growth in defense capex should actually benefit Bharat Electronic, while muted infra capex growth might be sentimentally negative for L&T. Importantly, the consumption space, that's the most talked about, and the budget And the Investec has stated that there would be a direct boost coming in the urban consumption. They have maintained buy calls for GCPL, Marico and ITC, out of which 30% comes from the urban segment. Nestle Britannia is also in the pecking order, apart from Radico Khaitan, United Spirits and United Breweries as well. They are also bullish on the higher ticket consumptions coming for Nykaa, Titan and Sapphire Foods as well. And lastly, ITC would be in focus. Jefferies has maintained buy rating, target price coming in at 550 rupees per share, and stock comes out as the winner, with government leaving tobacco taxes unchanged, and GST rates also are likely to settle in March 2026 as the tobacco taxes remain unchanged.